to the Inspire Wealth podcast with Prof, where we dive into the world of real estate investing and wealth building strategies. I'm your host, Mallory Meehan. I'm a real estate professor, attorney, and seasoned investor here to guide you through the ins and outs of creating wealth through real estate. If you're looking to take your real estate knowledge to the next level, don't forget to subscribe to stay up to date with our latest episodes and offerings. Welcome to another episode of Inspire Wealth. I am your host, Prof M, and today I am joined by Dave Wolcott. Dave, I'm so excited to have you on the show. Welcome.
Hey, Mallory, really grateful to be here and connect with you and your audience.
Love it. All right, Dave. So you are an author. You are basically the wealth building inspiree is what I want to refer to you as. And so why don't you start by kind of taking us to where your journey all started, and then we'll kind of dive into a little bit about your book and some of the things that you're working on.
Yeah, for sure. So I was actually raised pretty close to you in Connecticut and was told that the recipe for success was go to school, get good grades, you're going to get a job, and life would just work out, right? So I followed down that path. I actually went to GW in DC, close to you as well, and then had the opportunity to do the ROTC program, got into the Marine Corps, and learned some amazing things in the Marines, things that they don't really teach you anywhere else in the world, such as leadership, teamwork, and integrity. After I transitioned out of the Marine Corps, I got into the tech industry. And at the same time, my wife and I were trying to raise a family. We actually had an 18-month-old toddler ruling the roost, running around. And October 24th, 2000, we literally had triplets and quadrupled the size of our family.
Oh
So
my gosh.
if you can only imagine, right? This is something you read about in the newspapers, but I can tell you when I was holding three babies in my arms at the same time, this paternal instinct just really came through for me. And I realized, like, financial security was everything for me. I have got to be able to provide for my family. And so, the first thing I did was I went to see my financial planner. And he told me the same thing that they all said, which is, don't worry about it. Just max out your 401k. They have these things called 529 plans, which are going to get some state tax savings, right? And we can invest there. And it was right then, Mallory, that I knew that the top 1% just weren't building their wealth as retail investors in the stock market. So this literally put me on this obsessive quest to figure out how the top 1% were actually building wealth. And keep in mind, this is back in 2000. There weren't great podcasts, YouTube, all these resources. So I had to look under every rock, read every book. Rich Dad, Poor Dad had literally just came out. I took the purple pill then and started investing in everything from single family to multifamily to raw land to office to retail. I invested in oil and gas and other alternative investments. Fast forward 20 years later, I did really well with that. And then I actually created Pantheon and wrote the holistic wealth strategy to really help people understand how this whole field works, right? What is the blueprint for the ultra wealthy, right? And how that can you actually achieve that to build that life that you've always wanted?
Right. And I think that that is one of the biggest messages that we're receiving is that, you go to school, you stay in school from kindergarten to 12th grade, and essentially we are preparing you to be an employee. We're not teaching you how to create your own wealth, but rather to have a job that you're getting a paycheck. And it's kind of breaking that cycle, and like, how do we get out of that cycle, and how can we educate people? And so I want to learn more about your 5 phases that you created within your book. So can you walk us through what those 5 phases look like so that, maybe we can help break the mold, and maybe we can help our listeners at least understand what else is out there?
Yeah, 100%. So the first step is actually creating a vision statement for yourself. Because if you don't have a target, you're going to miss every time,
Mhm.
right? And what's one of the first things we do if we're going on a long road trip? You actually pick your destination, right? So you know exactly where you're going. But sadly, most people, we live in such a reactionary, kind of world. We're responding to this and to that, that we don't really have time to get that clarity on what our vision is, where we're actually trying to go. So the entire five-phase strategy is underpinned by first creating your vision statement. And then we move into phase one, which is actually all about you. And this is really so apropos that, you and I are having this conversation, right? Because it's actually all about having a growth mindset and learning, right? And teaching. Whereas there's so many other people, I can tell you that, the first times I was looking to invest in real estate and alternatives and telling my family members, my friends, my colleagues, hey, I found this great real estate deal. And I was met with, well, my financial planner says that's a bad idea. He says it's too risky. My family thought I was crazy, to do all of these things. So it really starts with, having that growth mindset and being open to new ideas outside of conventional thinking, that where the, 98% is thinking, you need to be thinking about, new ideas. And from there, you're actually creating goals and habits that actually support your vision. Right? How are you learning every day? Is that instantiated in your habits and things? Because when you have that growth mindset, you'll be open to new ideas and you can start asking questions like, does it really make sense, for instance, to defer my taxes in a 401k, right? So that I'm going to actually now pay taxes at the highest tax rate that's going to be, you're going to pay ordinary income taxes, when you retire. And I mean, I don't have a crystal ball, but one thing I'm probably certain of is taxes are going to be higher in the future than they are today. So wouldn't you rather pay taxes on the seed rather than the harvest, right? But it's all about having that mindset to start asking questions, start asking why, and start learning more for yourself.
Right. No, and I think that's a great point, especially when people are thinking about retirement and we want to think about inflation too, because the cost of living is only going to go up. And so the power of the dollar is only going to go down. And putting that money away today, not being taxed on it, and then being taxed on it in the future, the value of it just went down exponentially.
Yeah, for sure.
Okay, so we have phase one, and a lot of it has to do with mindset. And I think that that's, a hard thing for a lot of people, getting out of that routine or that mindset of this is what I've been taught all along. How can I do that? So, what kind of advice do you give people when they're trying to figure out, okay, how do I start a habit to make sure that I am focusing on the right investments for my future versus what was traditionally taught to me?
Yeah, again, I really think it starts with that mindset before you even get in the tactics of figuring out what investment is right for me. Because if you think you're just going to outsource your wealth to a financial planner
Mhm.
and you think you're going to get ahead, um, you're definitely mistaken, right? But when you can start to open your mind again to what are other possibilities, also, who are you surrounding yourself with? Right? Like Jim Rohn likes to say, right? You're a product of the five people that you spend your time with. So who are actually those people that are leveling you up? Are you spending time, right? In Mallory's class or listening to this podcast or other podcasts to really see how other people have completely leveled up. They've had success in their learning. Or are you spending time at neighborhood parties where everyone, the only thing they're talking about is when they're going to retire, right? And how their 401k is doing, or at best, maybe, their latest stock pick, you know? But that's not really the right approach. It's all about mindset. And another great example of this is, I mean, just think about, we all have, let's say, a friend we used to know maybe in high school that's literally in the same town, the same set of friends, and the same job. And
Mhm.
compare that person against someone like Elon Musk, who literally every week is doing something groundbreaking you couldn't even possibly think about,
Right.
right? But what is the difference? It's mindset.
Mhm. Okay. So we got to get that mindset straight to get past the first phase. What is phase two once we're able to get that mindset together?
So, phase two, again, you're going to absolutely love this one. It's all about increasing your IQ and your IQ in a holistic way that covers multiple dimensions. So, not only do we want to learn about financial IQ and understand that, hey, there's different investments. For instance, if you invest in oil and gas and actually partner with the government, 100% of your investment is actually tax deductible. It's a tax offset to your active income. Most people don't realize that, right? So there are other ways to increase your financial IQ that will help you achieve your goals, but you're never going to learn that unless you're trying to increase that financial IQ. There's also other things such as increasing your mindset IQ. Also think about your physical capital and all these other forms of capital. And, oftentimes I think, being rich and being wealthy are really two different things. And
Mhm.
we're surrounded in this world of social media that just puts, rich in your face, which is the fancier car, the bigger house, the yacht, the this, the that, right? But in reality, when you spend time with centimillionaires and billionaires, they really understand it's all these other things, things such as your physical capital, your spiritual capital, your emotional capital, right?
Mhm.
All of these things are really important. Once you get past this level of just, financial security, right? You're living a life of abundance, but you need to have your health,
Mhm.
right? You could have all the money in the world, but if you didn't have your health, right, where is that going to get you? So you really want to be thinking kind of holistically around increasing your IQ and really increasing these other layers of capital to move you forward.
I love that because I think for me, I have my mental and physical kind of together and, going to exercise and going to the gym, that is like my reset. And that is like my zone where I have no distractions. I make sure that that is at least an hour of my day that I can just, do what I need to do. And I think that a lot of people take that for granted and they, basically say, I don't have time to work out. I don't have time to do these things. And until you make the time, nothing else in your life is going to help fall into place, in my view.
Yeah, 100%. I mean, look at Steve Jobs, right? He had all the money in the world, but he couldn't buy himself another day.
Mhm.
Right. So that's how, important this is. Or, think about relationship capital, right? You could be one relationship away from the biggest opportunity of your life, you
Yeah.
know? And there were times, the other thing is, there were so many times in my life that I actually did not have capital to invest. And I felt like, wow, I really want to move forward. I want to invest in the next opportunity. I'm anxious to grow. But what could I do? Well, I was pouring through every possible book I could. I was meeting everyone I could to find even bigger and better opportunities or to learn about, different things that I could do, right? And all at the same time, yeah, I'm working on my health, which is really foundational to everything.
Yeah, absolutely. Okay, so we have mindset as phase one, and then we have increasing your IQ within different capacities as phase two. What is phase three?
So phase three is, we're all excited to always build wealth, but we also need to protect and preserve our wealth. So it's really creating a dream team and infrastructure around your wealth, such as family offices have, and that's why we run actually a virtual family office. And this consists of setting up all of these key roles, things such as estate planning, tax strategy, which means using a tax planner, not a tax preparer, but
Mhm.
someone who's proactively working on a tax strategy for you. We also love the concept of infinite banking, which is a complete multiplier, right? Where you can add more velocity to your capital. You can put capital in, it's going to compound completely tax free. You can use that to borrow against that to put into your next deal. Um, and there's multiple benefits to that as well. So creating all of these different areas, estate planning, asset protection, tax strategy, the financial planning component, and infinite banking together really create this infrastructure. And then you want to have also this dream team of advisors that can really support you on this journey.
Yeah. Can you dive into the infinity banking? Because I think that's a topic that a lot of people don't necessarily understand.
Yeah, for sure. So, this is also something, I've been using for 15 years. So we started offering it to our clients. We're licensed in this, and it's really simple. There's a lot of confusion in the marketplace. People talk about different things. And actually, if you were to call an insurance provider, oftentimes if you told them about this, they wouldn't even understand what you're talking about. But this gentleman named Nelson Nash really kind of was the forefather of really creating this. But simply put, it's a cash value whole life insurance policy. So what you do is you actually put cash into the life insurance policy. You're going to get a death benefit associated with that, just like you would expect in a life insurance policy. But the really cool thing is the way this is structured is you're able to get all these multiple benefits from it. So number one, that cash value starts compounding tax free at about a rate of 6%. Then you also have an estate planning component where when you pass, it will go to your heirs and avoid probate and taxes, right?
Hmm.
So you have a nice tax, estate planning component to that as well. It also has a form of asset protection to it because it's life insurance. And now you're housing your assets in there so creditors can't find that. The first thing creditors are going to look for is equity in your house and all of your stock equities portfolios because those are liquid, but they
Hmm.
can't touch the life insurance. This also creates a reverse income stream. So, I don't even like the word retirement because if you love what you're doing, you'll never retire.
Yeah.
So, let's say in your later years, that you're looking for some income, well, you actually borrow against the policy and you can use that for tax-free income in your later years. And that income will never run out as long as you're alive, right? And then the other really cool thing about this is that you can actually borrow the out of the cash value of the policy to then invest in your next real estate deal. You could even pay for your kids' college. Frankly, you could do whatever you want with that. And what that does is there's usually a small spread in between the loan you take out on it and what the rate is growing. So you get a little bit of an arbitrage there.
Hmm.
And now you put that into a higher returning vehicle, and
Right.
you've just now added a lot more velocity to your overall portfolio. And oh, by the way, you have control. You've now taken over that banking function. So oftentimes they call it banking on yourself or things like that. So you actually have control on that banking function, and not some financial institution, right?
No, I love that. That's awesome.
Yeah.
Okay, so we are at phase three and we create that dream team and we want to make sure that we have all of our assets, our tax strategy, financial planning, estate planning, infinity banking. What do we get when we get to phase four?
So in phase four, it's interesting, I really started this concept and trying to explain for other people how to really break free from conventional financial planning, right? And oftentimes people will be really excited. They've got first three phases down, and now they're like, okay, I don't have capital, right? I want to invest, I want to do something.
Right.
Well, this is all about looking at what you do have. And over 90% of Americans have their capital tied up in two places. It's either in trapped equity in their primary residence or in some rental properties, or it's in government sponsored qualified plans, 401ks and IRAs.
Hmm.
So on the 401k side, right, you really have to look at the average of the past, 20 to 30 years of what the S&P has been producing. And it's really 7.5%. Everyone gets that annual statement. They might think, Hey, we did 15% this year. That's great. But what about 2008? What about 2000, right? When the market took a hit on that cumulative number and brought you down 30%, right? That's what averages this whole thing out. So if I can take seven and that pool of capital that's at 7.5% and put that into another vehicle. So for instance, we have a private credit fund right now, which is investing in merchant cash advances. It's got over a 20% return to it. So if
Mm,
I can bump up this 7.5% return to a 20% return, right? That is completely optimizing what you already have. And there's ways for people to do this. So, number one, the easiest way is a self-directed IRA. I'm sure you've probably talked about that with your guests. It's just basically a different custodian. So
mhm,
you have the say of choosing the assets you invest in. And the second way is, and again, I'm not a financial planner or CPA. This is not financial advice, but I became so confident in my strategies that 15 years ago, I literally, my last, pot to go after was my 401k. So I built a 401k exit calculator to make a quantitative decision on whether it made sense to invest in real estate, which I knew I was having success with, and could I do better?
mm,
And I literally within, I've over tripled, maybe even quadrupled my money since then. So I actually sold it, paid the 10% penalty, paid the taxes. But again, remember, you want to pay taxes on the seed, not the harvest. And by the way, I was able to offset that 10% penalty by an investment in oil and gas, right? So I mitigated that, and I've never looked back, right? And now I have control over those funds. I don't have to wait till I'm, you know, a certain age. They're going to tell me how much I can take out with RMDs and all these things.
mhm.
So, that's definitely something to think about depending on where you are in your, wealth journey, right? And for a lot of those younger folks, those things can be, they're golden handcuffs that these companies put on you. And they say, "Oh, I've even got a 3% match." Well, I'll tell you, do the math and see what that really looks like. Because
Right.
even that 7.5% money, you start to add in taxes, fees, and inflation, it's more like 4%, right?
Right.
So that's a big one. And then the second one that I'll talk about, Mallory, and I know you're big in active investing, but you know, Kiyosaki talks about it, right? Your house is not an asset. Maybe we could debate that. There's some different ways to look at that. But the one thing that's for sure is if you have equity in your primary residence, the rate of return on that equity is zero.
Hmm. Right.
Okay. So I'm not necessarily saying you should, change that LTV to some level that you're uncomfortable with. But I meet a ton of investors, high net worth people that, hey, I've got money, so I just paid off the house. We always felt like that would be great. We paid off the house. Well, if the bank's going to give you money at 7% and I can make 20% somewhere else, why in the world would you do that? And oh, by the way, there's some other things to think about. You increase your mortgage interest deduction, right? By having the mortgage. And the other thing is, again, let's talk about from a risk profile. When the bank owns 80% of your house, they have more risk in that than you do. So if a creditor, you've got teenagers driving or things like that, and a creditor comes after you, and your house is paid off, they're going to completely go after that house. But if
Mhm.
the bank has it, eh, not as much,
Yeah.
right? So we want to be thinking about these things from kind of a 360-degree viewpoint. And again, these are things your financial planner is not going to be advising you on.
Right. And we also have to understand the financial advisors are getting paid through most of the time specific stocks, mutual funds, or other financial, capital that aren't going to be real estate transactions. They're not going to be alternative transactions. And so we have to really kind of understand why they're promoting one thing over the other. And a lot of people, yeah, the financial advisors are going to tell you real estate's a risky asset. I'd be careful to invest in that because guess what? they're not going to get paid on anything if they were to recommend you put your money into that real estate asset.
It's funny, right? I mean, they call real estate and these other things alternatives, right?
Hmm.
But I don't know about you, but I mean, real estate's one of the oldest asset classes in the history of time,
Right,
right? So I'm not sure why it's alternative. It's alternative to them, right?
right,
Because it's this multi-trillion dollar, and that's really the source, I think, of a lot of the education and some of the systemic challenges here, is that there's this multi-trillion dollar financial services industry that wants you to think their agenda is the only way. And as you
right.
pointed out, they primarily operate under this assets under management model, which is the more of your capital that's tied up under them, they're just making fees on that. And one of the things that's frustrating to me is that even when the market goes down, they're still making those fees on that. But
Right.
when you start to invest in private equity and private assets, right, most of these things are performance driven, where the sponsors get paid on the back end based on how well the investment does.
Mm-hmm. 100%. Okay, so phase four, we got to make sure that we're really make keeping in mind all of our buckets, right? And where we're putting our money. So from phase four, what does that take us into for phase five?
So phase five is the really fun one. It's all about building massive passive income. And our investment thesis points to asset classes that are non-correlated to the stock market, and they have very strong macroeconomic fundamentals, meaning that there's always a shorter supply than there is demand, right? So we want to always be investing in those for the next 10 years or so,
Mm.
right? So that you're investing where the puck is going. You're making long-term decisions, right? Not who's in office at a certain time, right? We want to be, really calculating that well. And then from a return profile standpoint, we invest in asset classes that what I like to call is really provide a trifecta return, meaning that you're getting tax efficiency, you're getting passive income, and you're getting forced appreciation on the asset class. Not just appreciation growth. I'm saying forced appreciation where we're driving value into the asset class. Because in that way, right, we have exponential upside as well as protecting our downside at multiple levels, right? So, for instance, in the oil and gas, this is a perfect example. And a lot of people are familiar with real estate and less on oil and gas, but again, you get this tax offset to your active income, and you're going to get that regardless of whether the opportunity performs or not. So that comes right out of the gate, which is like probably worth the 40% of your investment, right? It's very significant. So that's an example there. But then, that investment also has nice passive income, and a lot of these assets they will try to exit or maybe build up the assets just like in real estate, right? Where they can grow the value, then sell it off to a larger producer as well. So it follows that similar track.
Okay. So if I were looking to invest in an oil and gas kind of asset, we'll just say, what kind of metrics or where could I go to find some of these kind of deals? And then once I've identified those deals, give us maybe like a case study of how that the income from that really helps offset if you are going to stay with a W-2 and that active income.
Yeah, so you just identified a big challenge in the market. So the more I learned about the private markets, I then started to realize, okay, how am I going to get access to these deals? How am I going to kind of figure it out?
Right.
And then once you start building relationships and you start understanding how the market works, you soon realize that there's a lot of deals out in the marketplace, but how can you find good operators with a good track record? So that's one of our jobs at Pantheon, where we're trying to actually partner with top tier sponsors that we have relationships with. We understand their track record, and then we vet them with our own due diligence and then bring those forward to our investors. So that's kind of how we're bringing deals to the table. And then the other thing about our model is that, so like our last oil and gas deal, for instance, the minimum investment was 10 million. But what we were able to do is actually we can create a sub fund, so basically like a fund of funds model or a special purpose vehicle
Mhm.
to be one investor to them, and then therefore we can open it up to our investor base, for as little as 50K to get access to the same deal, right? So that's kind of how that works. And then just, I guess, to answer the second part of your question, let's say an investor had invested 100K in this specific opportunity in December of 2024. You invest 100K, you will get back on your K1 it would show your basis of 100K investment, but then it's going to show an active loss on paper. So real estate, you'll get the passive loss
Mhm.
box, and in oil and gas, it's going to show an active loss. And in year one on this particular deal, we were up to about 92%. So now you have a $92,000 paper loss
Wow.
on the asset, right? So if you're making $100,000 in income, instead of paying taxes on 100,000 in income, you're now only paying taxes on $8,000 of income.
That's
Okay.
incredible.
Okay. So
Yeah.
that's why I'm saying it's a trifecta, right? And you've now minimized your risk by 30, 40%, whatever tax bracket you're actually in. And then not to mention, now you start to get a return of capital back, starts to come back. So you're getting your capital back. Then you start making distributions on these things because there's a massive shortage of oil and gas in the world. And as much as we're green supporters, we're just not there yet.
Right.
And the demand is just so, so strong right now, especially with AI and everything that's happening for energy.
Yeah. So if and I know that this is not real estate, but I would imagine oil and gas is kind of a real estate investment in a way because you're investing in the land and the mineral
Yeah.
rights
Yeah.
tied to the land. So what kind of returns have you typically seen on that specific type of investment for your clients?
Yeah, I would say 20 plus percent. Our target is 20 plus percent on our deals. And that's even the IRR on that one specifically was 62% if you include the tax benefits year one, right?
Yeah.
So this is what I say, when it all comes back to financial education and you start to understand this, and now, we have investors that are legally not paying, basically very marginal amounts in taxes, but because they've understood that taxes are actually a roadmap of incentives for
Mhm.
business owners and investors who know how to use them. And the reason being is if you think about it from the government standpoint, we use energy for literally everything in this country. It supports our national defense, it supports our GDP. We need it for everything. And the production from the US, we really need that. And 80% of it is actually smaller producers. So when you invest there, that tax incentive has been in place since the Reagan era.
Yeah. And I think that's another thing with mindset is getting over the fact that people assume that you have to pay tax and that that's part of your American duty to pay tax. And until they actually understand the purpose of why the IRS wrote the tax code and some of the benefits that are provided for investors, where yes, you're not paying income taxes, but you're providing things that are helping the overall society. And that's your contribution. And so I think, again, it's that mindset switch that when we hear people say, I don't pay anything in taxes, the tradition would be, oh, you're a crook and you're not fulfilling your duty. Well, no, I'm putting money into these assets and I'm providing housing or I'm providing opportunities for people to put businesses, or I'm providing an additional fund to help, you know, provide energy sources. And, I think educating people on those specific components with just the tax code itself would be exponentially important to help people get to these financial journeys as well.
Yeah, exactly. It's not that you're not paying taxes, you're just reinvesting in a way that, puts you as a partner. It's a real paradigm shift to think about. It's like, how
Yeah.
can we actually partner with the government? And the tax code is there as an incentive because that's where they need help, right?
Yeah.
Just like you say, real estate is a perfect one where we have big shortages in housing. So that's why they're providing this bonus depreciation and these other benefits for you.
Yeah, and I like to tell my students that you have to think about the public versus the private. And when the public sector is not capable or not efficient at being able to produce some of these things, they're going to provide incentives for the private markets to help offset those things. So, government funding is not in the business of development. They're not in the business of, you know, putting out money to build office space or build warehouses or distribution centers. And so, because they know that that's not their lane, they're putting those tax incentives on the private market. And so, people that invest in that get those benefits. And, I think I could talk about tax with you probably for another hour, and that's
Yeah.
another whole,
Yep.
kind of component. But so we are now kind of within those 5 phases. And so, if somebody were to buy your book, Dave, tell us exactly what overall you're hoping people take from the phases and from the resources that you provide your readers, but then also your investors that you have through Pantheon.
Yeah, so my goal is really to change the way people think about and view wealth, right? And we're often again just surrounded by this world of like conventional wisdom, conventional financial planning. Well, I'm doing that because my brother-in-law is doing that, right? Or, my peers said doing the 401k, really makes sense, right? But you really need to change, the way you think about that, and you need to get crystal clear on what wealth even means to you, right? Instead of just chasing the dollar, understand what it's all for. Because at the end of the day, again, once you pass that level of having enough money, right, you add another zero to your portfolio, and then how does that meaningfully actually change your life, right?
Mm-hmm.
Maybe it provides you more time to travel, maybe more time to be with your family. Maybe you can stop trading your time for money, right? Maybe you can start investing in your health, right? And feeling more optimal. So really just to help people with that and think through about a completely different way. And this is a flexible enough framework that wherever you are on that journey, I mean, we have, I mean, people literally at, 8, 9 figures that are still seeing a ton of value in this, as much as this is what I'm teaching my kids. And I'm watching my kids go through this same thing. And this is a great, example, I would love to share as well. So my daughter, she's 26, and we talk about this really openly in our household. And we have been since high school, right? We're always masterminding on these concepts. Well, she graduated Virginia Tech and she started in college. So the money she saved during the summers or in college, she put into an infinite banking policy in the life insurance policy.
Mm-hmm.
She graduated. Her and her boyfriend at the time bought a house in Knoxville, Tennessee. They borrowed money against their life insurance policy to make the down payment to the house. They went in and completely did like a fixed up the house. They lived there for 18 months. And then they built up 130K of equity, right, in less than 2 years. Then they went and bought another house. Then they were cash flowing that house for about 1,700 bucks a month. And that was literally at 24, right? Right
Yeah.
after college. And now they're about buying their third house, and then they've sold the first one, and they're doing it again on the second one,
Wow.
right? So this is exactly how you can go through this entire journey, right? She changed her mindset by not just investing in 401ks like everyone else is. She
Mhm.
used the strategy of leveraging the infinite banking policy to have control of her capital,
Mhm.
right? They followed all of the concepts of real estate that you teach as well, right? That's clear. Built up that equity. Can you imagine like her peers, and now she's 26, and her balance sheet is so healthy. If you were even making six figures out of college and putting away 20% of your money, how long it would take to get to, over
Yeah.
100K, 200K. I mean,
Right.
that's a lot of years of trading your time for money, right?
Right.
So this is how that strategy can work, regardless of where your net worth is. It's all about the most important real estate, which is the real estate between your ears.
I couldn't have said that better. I think that that is the most important real estate that we all have is our mind and the education that we put into that. And so, Dave, I love talking to you. I think that you bring so much wisdom, so much financial guidance. People who are interested in getting your book or getting in touch with you, what's the best way to reach out?
Yeah, so what I wanted to do for your guest, Mallory, is actually create a special offer where if you'd like a free copy of the book, you can just go to holisticwealthstrategy.com.
I love that. Thank you so much. That's awesome. And make sure that you check out Dave's book. Again, the Holistic Wealth Strategy, 5 phases that will help you hopefully build long-term wealth. Dave, it's been a pleasure speaking with you, and I look forward to continuing our journey together and hopefully having you back on the show again.
Likewise, Mallory, it's always great to connect.
Awesome. All right, until next time, I am Prof M out. And for those who want a more hands-on learning experience, check out our online courses at inspirewealtheducation.com. Whether you're just starting out or looking to expand your investment portfolio, I've created step-by-step guides and resources to help you achieve your financial goals. So hit that subscribe button and let's start building your wealth one episode at a time.